Hello, everyone. Today on the final bar, we will wrap the week, our normal Friday routine of looking how the markets have evolved in the last 7 days from last Friday to this Friday. Overall, the S&P trudging lower, sort of opened a little bit higher in the first hour and a half of trading after lunch, gave much of that back and more. But mid caps, small caps, sort of the juice, the offense that we would expect to do better in a bull market phase, closing higher just fine. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a still snowy Redmond, Washington. Thanks for joining us every weekday after the close as we look at the markets together using the power of stock charts, using the visualization techniques of the technical toolkit, focusing on the message of the markets as represented through price and breadth and sentiment. And Friday's show is a good one because we hit on all three of those. I've always talked about my macro discipline is in those three parts, and they're in order of priority. First is price, second is breadth, third is sentiment. What you'll find right now as we look at things is if you measure things purely on price behavior, it's hard to be anything but positive when you have stocks like Deere blowing out strong earnings up 10+% in a day. At the end, continuing on this long bull run that they've had. Stocks like Plug Power that have been on sort of offense that a lot of people have been in, pulled back to their 50-day resolving to the upside. Things like that make you look, seem pretty confident. When you look at breadth, though, it gets a little more mixed. When you look at sentiment, it gets a little more mixed because it's all about those relationships about the breadth and the sentiment conditions relative to price itself. So on its own, the trends are up. Are we seeing warning signs in the tape? We'll review that together. Now, we have some great guests helping us along the way. This week, what a fantastic group of guests. Yesterday, I had Ryan Dietrich from LPL Financial. He brought a couple of really good long-term charts focusing on the cyclical and secular patterns in the S&P. If you missed that, certainly go review his comments. Peter Brandt earlier in the week as well with some good big picture thoughts as well. Next week, more of the same, some quality guests. On Tuesday, the 23rd, Keith Fitzgerald from the Fitzgerald Group. On Wednesday, the 24th, Tim Tashler from Sprott Global. And then on Thursday, author, trader, educator, Cliff Droke coming back on the show. I want to start our Wrap the Week segment with a poll. Asked you recently, a little more of a how well do you know your charts sort of question. What would Charles Dow, the father of technical analysis, consider an uptrend? Higher highs and higher lows, higher highs and lower lows, lower highs and higher lows, lower lows and lower highs. And if you've watched this show at least one episode, you probably know the answer because these words come out of my mouth many times a day to the point that my family, now that I am working from home and saying these things loudly, they laugh about how often I say them. I'm sure they have a pool going within the family of how many times I will say it on one particular day. The answer is 92% of you correctly said higher highs and higher lows. The reason why this is important is, if you know nothing else about a stock or an ETF, bring up the chart and answer that question. Is this in a Dow theory uptrend or a downtrend or neither? Is it going sideways? And that first question, I would argue, is the most important one to answer. Everything else is subsequent to that. It's less important than that basic starting point. Is this chart in an uptrend or downtrend? Start there. Overall, you're going to be in pretty decent shape, I would argue. Let's continue on wrapping the week. As I mentioned, the S&P sort of flattened down today and continued yesterday's rally in the first couple hours, but then from there gave all of it back and more. Was not able to get back in the positive territory. Closed down about 0.2%. Let's look at the wrap the week chart and look at the weekly returns, and then we'll focus a little bit on today's trading. Looking at the weekly chart, this is looking at the last couple trading days. We're actually starting this a little wrong. Hold on here. I forgot about the holiday. So let's take this from Friday. My labels are all messed up, and forgive me for that, but I'll talk you through it just fine. We're starting the clock on Friday and looking at where we've been since there. So here's the S&P 500 at negative about 0.7% when all is said and done. So really gave up, a little less than 1% from last Friday's close. Not so bad. And if you think about it, the last week and a half has really been sideways, been a digestion phase is what I usually call it. What underperformed stocks in the last 4 trading days? Again, we had the shortened holiday week because of President's Day on Monday. Crude oil was actually just in line with the S&P. This is the brown line you see coming down here. That's crude oil down also about 0.6, 0.7%. What else underperformed the large cap equity universe? Small caps down 0.9%. The NASDAQ 100 down 1.6%. Gold down 2%. The worst of all of them, bond prices down 0.6%. Sorry, minus 2.6%. And again, we're using ETFs as a proxy for most of these. So GLD for gold and the TLT for bond prices, but certainly the weakest out of most lists of things you would look at. What outperformed the S&P this week in orange here? This is emerging markets down 0.5%. In green, the U.S. dollar essentially flat for the week, but down about 0.2, and that's it. If we look at the next chart, this is including Bitcoin. I'll tweak this just for the start date here. Bear with me. But the blue line on the top, that's Bitcoin here. So the reason why I usually break it out, everything we just looked at is down here. Here's Bitcoin up 17% for the week. So if you're looking for the juice, if you're looking for where the movement has come from in the last week, it's Bitcoin. And, starting there, the chart of Bitcoin has certainly been up and to the right, closing above 55,000 for the first time today. That's after getting to 53 and 54,000 earlier today for the first time. So certainly in a position of strength. And again, big days like this, up 7 to 8%, are certainly a compelling move, something you want to pay attention to. Remember, this is just the latest step in a series of steps. When Bitcoin pulled back to 30,000, which was a 38.2% retracement of the September to January rally, that was a decent starting point to this next leg higher. When it broke above 42,000 above the January peak, that suggests to me we go much further from there. So the back of the envelope, what's the measurement if you take the height of this move and project it up there very quickly? We got to about 29,000 up to 42,000, which means you double that or extend the height of that pattern. That same amount, that's 13,000. That brings us to 55,000, which is where we reached just today. So the initial minimum objective based on the height of that base, arguably we hit today. So the question is, going into the weekend and into next week, do we have enough upside momentum to continue past and push higher? I would not be surprised if Bitcoin doubled from here, if not more, and got to a 6-digit value. That certainly could be the case. I am also 100% certain that there will be a lot of painful moves between here and there if that is the case. So plenty of volatility certainly remaining to be had in that space. Looking very quickly at what else has moved, and then we'll get to the Mindful Investor Live chart list. Big story today, and we'll just hit on a couple things. So the NASDAQ down more than the S&P, mid caps and small caps up. So the while the S&P closed down 0.2%, the small cap index, the S&P 600, closed up 1.7%. So small cap, sort of the higher beta, higher risk, higher potential return space, certainly doing well. This is more offense over defense. Bond yields continue to appreciate with the 10-year going above 1.3%. The TLT down 1.3% today. Gold prices a little bit higher, as well as silver prices. So commodities as a whole came off a bit, with the USO lower, the DBC, which is a broad commodity index, sort of flat to down, precious metals up, and other sort of mix. And you can see crypto is essentially all in the green, going higher, and Bitcoin again getting above 55,000 for the first time today. In terms of sectors, the leadership was sort of the late cyclical, value-oriented space: materials, industrials, energy, financials. Those are the big winners today. The underperformers: utilities, consumer staples, and healthcare. So this is not a question of defense over offense. It's not like the market went down and people were taking their foot off the gas pedal. It's a little more of a rotation away from things like the FANG stocks into things like John Deere and Freeport-McMoRan and energy and financials, American Express. These are stocks that are all in pretty good uptrends at or near new highs, continuing to push to the upside. Let's continue on to the Mindful Investor Live chart. This is what we look at every Friday. If you've not seen this before, you can access it in your own login. Go to your member dashboard, click on articles at the top, go to my blog, which is called The Mindful Investor, and there'll be a link at the top of my page to go to this chart list. I update it every week as I'm preparing for the show, and you're welcome to follow along, save them in your own login, do whatever you like. Chart number one is our market trend model. This looks at weekly data and has a long-term, medium-term, short-term component based on weekly exponential moving averages. Long story short, these have all been bullish for quite a while. The long-term model has been bullish since early June of 2020. The medium-term model did a bit of a head fake in October of last year, but then turned back positive and has remained bullish since then. The short-term model, which is just simply looking at where we're at every Friday close versus the 5-week exponential moving average, has been bullish for the last month. Turned negative for 1 week after the pullback in January, turned back positive after that. So, how do I use this? This is more of a framework with which I approach the rest of my analysis. If this is all positive, which it is, it tells me to be looking opportunistically for stocks in good trends, stocks pulling back, stocks overall in good shape, because this is telling me the trends overall are positive. When the short-term and medium-term models start rolling over, that tells me to be thinking more about profit taking my foot off the gas pedal, thinking a little more defensively, cautiously. When they're all negative, that tells you it's too late to get defensive because the market's already really down pretty significantly. You want to be in cash or away as much as possible, and then you reset as things turn more positive. So overall, the fact that they're all positive tells me, until proven otherwise, the trend is positive. Look for good charts and good setups, and continue to expect further upside until the trend reverses. Now let's look at a daily chart of the S&P, a little more of the tactical time frame. So, we had this trend line drawn from the October low and the December low, lined up well with a couple points in January. We broke that. And what's interesting, excuse me, is if you look recently over the last week and a half, we actually came back up and tested that trend line from below and now have tapered off a bit. So, while the last week and a half have not been horribly negative for stocks, they certainly haven't been going up anymore. Now, while the overall trend week to week has been positive and we're continuing to make headway, on the tactical time frame, it's tapering off of it. It's going from an accumulation phase to more of a consolidation phase, again, in the last week and a half. So while that's not the end of the world, and again, for me as a trend follower, I'm more concerned when we break support levels than when the uptrend sort of takes a breather. Because there are plenty of time corrections. When the market has a nice run, it needs to digest that a little bit before it resumes higher. As long as we make higher highs and higher lows, we're in an uptrend, which means when we pull back the next time, which could be next week, it could be not for quite a while, but when we do, I'll be looking back at this last swing low, which will be around 3,700. So I think the first test of this market would be the 50-day moving average and a trend line using this new January low. That's around 3,800, just above there today, and the 50-day moving average not that far below there. So does the S&P hold the 50-day on a pullback in the coming weeks? That would be question number one. If it does, 3,700, I think, would be the real line in the sand. That's the most recent swing low. We break that, I think you have to start thinking a lot more about further potential downside. But it hasn't happened yet. The other thing that concerns me on a daily chart of the S&P, higher highs in price, lower peaks in momentum. And it's not just on the S&P. This is on many, many charts out there. Most charts that I bring up, in fact, are at new highs, are seeing new highs on lower momentum. If you bring up the average financial stock, energy stock, and I'll pick one randomly and see if I can do it, I would guess JP Morgan. Now, so JP Morgan's a little tough because it had a nice rally again today, and it's arguably not having a bearish divergence because the trend is still in place. You want to be careful not declaring this a non-confirmation when the uptrend isn't over yet. This could go up to 90 if the market rages on further from this. So let's look at, let's see, like a Berkshire Hathaway maybe isn't that? Nope, it certainly isn't. Okay, so far I'm failing in my attempt to bring up a good bearish divergence there. This might be one maybe you call. KeyBank with higher highs in price, lower peaks in RSI. What's interesting though is all these financials have just continued to have beautiful days here. So regional banks moving higher with Key up over almost 3.5% today, back up to the overbought region. Maybe XLE, let's see. So this might be a better example of that, right? Higher highs in price, lower peaks in the momentum. So, again, this is not the end of the world. And, as I may have mentioned earlier this week, it's one of those things where divergences have called 10 of the last 3 pullbacks, right? They tend to give plenty of false negatives. But again, it's like the Hindenburg omen, which is a macro indicator. It does not have a 100% hit rate. It has a lot of false signals, but any major corrections have usually been preceded by the Hindenburg omen, which is why when I see one, I pay attention to it. So same thing here. These bearish divergences are certainly a potential area of concern. You watch to see what actually plays out. let's continue on and get through as many of these charts as we can. I've been waffling, talking about divergences. When we look at the cumulative advanced decline lines, you have not seen any negative divergence or non-confirmation here. The breadth picture, again, in terms of the cumulative advanced decline line, continuing to agree. It's confirming price, higher highs in price, higher peaks in the advanced decline lines. You had negative divergences there in like early 2020, January, February, higher highs in price, lower peaks in breadth. We've not seen that yet. New highs have come off a bit in the last couple of days. It doesn't concern me a ton because we're sort of digesting things. So overall, still okay. Where we are seeing some negative breadth is this indicator. It's the percent of stocks above their 50-day moving average sloping downward. So every time the S&P pushes higher, you have less stocks actually regaining their 50-day moving average. It's a bit painful in my opinion. We talked about sentiment enough yesterday, so we'll skip that one. The equal weighted consumer discretionary versus consumer staples. What are these stocks in the offensive side versus defensive side of the consumer space doing? It is clearly favoring offense. The ratio is making a new 52-week high again this week. Overall, that is very bullish. Semiconductors continuing to outperform, certainly bullish. Small caps continuing to outperform large caps, sort of bullish. So you can see when we equal weighted S&P over regular S&P accelerating to the upside. So most of those measures of ratios, looking at people, how they're making bets around the equity space, high beta versus low vol, all these other ones, overall, all indicating strength over weakness. So that is the story. You're seeing strong price trends. We're seeing some warning signs in terms of bearish divergences and non-confirmations, some negative signals from breadth readings, but not across the board. And sentiment, as we talked about in detail yesterday, really at or near euphoric levels once again. That is the environment. We're going to take a quick commercial break, back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the show. Sometimes things totally work out when we're timing the show and getting things set up. There are literally lumberjacks not far outside my window taking a huge tree down to make space for a power line and making sure we all stay safe here. It sounded like we're having a log trimming masterclass in my office, and they magically stopped just before we started recording. So overall, things are holding up pretty well. It's great to have you join us on the show every weekday after the close. As a reminder, we're going to do another mailbag segment here in a moment. We'd love to answer one of your questions in our next mailbag on Tuesday of next week. Get your questions to us via email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv, or on our YouTube channel. Just put a comment below the video that you're watching. We'll do our best to get to your question, hopefully answer it on the air next Tuesday. Let's open up the mailbag now and answer some of your questions from the last couple days. First question, great show, David. I think the entire show you talked about a correction. I think that was yesterday or the day before, and I'm so sorry if I sounded so negative, but certainly what the data at times has suggested to me. How should a retail investor negotiate the correction? What I would like to know. Also, can we compute the relative strength of individual stocks versus S&P sectors? I will answer both of those very quickly. Peter Lynch, who was a former colleague and certainly mentor to many of us at Fidelity, one of his quotes rings true. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. When you hear me talking about some of these bearish divergences and the potential for correction, I'm cognizant of the fact that many of us have different time frames, different questions that we're trying to answer, different ways we're trying to win this game of sorts, if it's winnable at all. And so some of us are thinking more tactically. So when I'm talking about comments about corrections, thinking about an S&P pulling back to 3,200, it's thinking more tactically about how you might want to scale in or out of positions, more of a swing trading approach, and how you'd want to think about that. As a long-term investor, though, if your runway is long enough, my conversation with Ryan Dietrich this week sort of makes sense. Whether or not we get a pullback, a correction of sorts, long-term, you're certainly seeing signs of further upside from here in years from now. I have very little doubt that a couple of years from now we'll be higher than we are now in the S&P. I think that's a reasonable expectation. And again, I could be totally proven wrong. And when the trend reverses and stays down, I'll be the first to tell you that. But overall, you're seeing conditions now that are in line with previous bull market phases, and not at the end of them, but further on. But we are seeing signs of being at the end of a cyclical bull market phase, sort of the time when the market is overheated and euphoric and needs to come off a little bit. Having said that, timing corrections is very, very difficult. I think of them more opportunistically, and as a long-term investor, I'm thinking about a retirement account. It's an opportunity to get, for some of my former money manager colleagues would say, buy good companies on discount. So that's how I would kind of think about it. Can you compute relative strength of individual stocks versus sectors? Absolutely. I actually don't have them on my charts a ton just because I tend to do it versus the S&P. But here at the bottom where I have XLE:SPY, just change that to sector or industry, and it'll automatically bring in the sector. And of course, I'm doing the XLE, which doesn't make sense. You have to bring up a stock that actually, that has a sector assignment. You can see it's automatically bringing in the XLY because I brought in a cruise line. So that is the way you do it. $sector, $industry. I believe both work well, and it brings in the correct amount for whatever ticker that you bring in. So that wouldn't work for something like an ETF where it doesn't make sense. Next question, what happens when corporate bonds sink back under the earth? We all know the answer to that, and it's starting to happen around now. We may get down to even 3,200. What do you think? And you're absolutely right. I talking about bond prices coming off, and one of my 3-in-3 charts yesterday or the day before was the shape of the yield curve and the steepening yield curve. Wednesday, Peter Brandt was pointing out the 5-year, the 2-year yield, I forget which one, breaking out to the upside. We've talked about the 10-year yield going higher, and certainly a downtrend in bonds is something we're not used to seeing for quite a while. A rising rate environment is something that I've certainly never seen in my 21 years of trying to analyze the markets. And again, I think you had to be investing before 1980 to have experienced a rising rate environment and what that does to stocks. So this is uncharted territory, pun intended, for a lot of investors. And I think that is going to be a fascinating experience for many younger, newer investors that have not seen what happens when rates rise. Dave, can you please confirm that the extended hours trading will not be affecting candle ranges intra-week on longer term charts like weeklies and monthlies? And you're right. So you're actually pointing out on ACP and also in our regular charts, there's this new little thing called extended hours. It's a little different in ACP, but same capabilities. In ACP, you can actually chart the pre and post market sessions. In our sharp charts, you can do the pre and post market sessions now. If you missed that, my colleague Grayson Rose, last Friday or Saturday, he has a show called StockCharts in Focus. Check it out because he focused all on this, I think, last weekend. Really well done, explains how to bring it up. If you bring this up on a chart like this, it's not going to be that exciting. All it's going to do is add the post-market data when the post-market session is engaged. It will update your charts only on intraday charts. So if you have an hourly chart or something less than that, you will see the pre and post market session. It's not going to affect the chart at all on a daily chart, weekly chart, monthly chart. So to answer your question, that is correct. It should not mess with your charts at all. It's actually not even looking at that data. So you're in the clear. Next question, I have a question about the price indicator relative to SPY. In sharp charts, when I'm setting up the default chart to include price, each time I move to a different symbol, the new symbol updates in the price indicator. It's kind of what I'm doing here. When I try to set up the same indicator in ACP, the symbol does not update. I see what you're doing. What you're doing is in here in ACP, you have this going on. So I have this price performance, and here I have said F:SPX. And what that's going to do is if I switch the stock, it's not going to update this at the bottom. I've changed the top to AT&T, and here it's still doing F:SPX. We haven't linked that up in a way that is the same as how it works in the box. And sorry, that's something we'll work on. What you can do is just use $ symbol instead of the actual ticker. And if you do that, it's going to update to whatever you put up here. So if I put up electronic arts, that should bring up EA versus the S&P. All right. So instead of using the ticker of the stock, just use $ symbol. That actually works in sharp charts as well. Just a lot of people don't use it that way. So if you use that, it'll work everywhere. We'll probably work on how to get that working more clearly or in a more similar way in ACP at some point, but that'll fix you in the short term. Next question. I've seen many chart people, quote unquote chart people, I guess I will consider myself one of those, write that there is no such thing as a triple top. Can you tell me what is the official verdict from the CMT Association on this issue? How would you interpret the investor psychology or meaning of 3 approximately equal peaks on a chart. You included this chart, the TAN, which is the solar ETF. Thanks for that question. Boy, I cannot officially speak for the CMT Association, but I can speak for myself as a technical analyst and having peers. And I actually serve on the Test and Standards Committee. So when you're taking CMT exams, those of you that do, I'm involved in making sure that those exams are running as they should in terms of the content and what we're testing on. So, what would be my comment on this? I would call it a valid pattern. It's not used as much, and triple top patterns are actually used more often in like point figure charts. There's a whole thing called a triple top pattern, which is more of a breakout pattern. So I'm not talking about that. Look at our chart school article on triple tops and we'll get into that. I don't mind what you're saying here about a double top would be two peaks at a similar level. A triple top would be a third peak. That's actually something that has certainly been in the vernacular as long as I've been doing this. And I think that's an acceptable thing. If you think about it, all you're doing with the triple top is saying it's a head and shoulder pattern where the head is not that much more elevated than the two shoulders. And it's like the head and the shoulder at even levels. And I think the thing to remember though about a triple top pattern is it's not anything like that. A head and shoulders top, a double top, a triple top is not a valid pattern until the neckline is broken. So you have to connect these support levels and get a valid breakdown of that support level, the interim lows, to confirm that was a pattern. At this point, it's just you can call it a triple top like pattern, and that would be an appropriate way to refer to it. Until you break the neckline, it's actually not a valid pattern. So hope that answers your question. I can't give you the official something from the organization, but I can tell you what my experience has been and what I would consider a valid analysis of that chart. That is the mailbag. Those are some fantastic questions. You guys touched on a little of everything this time, and thanks so much for that. Keep them coming. We didn't get to everything, and we'll get to more of them on Tuesday's segment, our next mailbag. Let's get to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is looking at the Russell 2000. You saw a situation today where the S&P was sort of flat to down, finished down, under 0.5%, but still below zero. But mid caps and small caps further up. And I think that continued outperformance, the resilience of small caps and mid caps really shows the strength of this market. This chart continued to go higher. This is the Russell 2000 ETF, up just over 2% today, continuing to go higher. The relative strength to continue to go up. That speaks to a strong, healthy market. That speaks to opportunities still being out there. So until that stops going up, I have to be, overall more bullishly biased than anything, and the trends certainly justify that. Chart number 2 is Tesla. So when you're thinking about sort of question marks, I often ask people what their one chart would be, right? If you had one chart to sort of gauge the overall health of the market besides the regular chart of the S&P, what would it be? Tesla might be one of mine, only because this is a high-flying name. A lot of people have been expecting great things of the stock and have been proven right, have been validated by the fact that the stock keeps going higher. Any opportunity it's had to break recent support has not really manifested. It's continued to go up. It's now once again pulled back to the 50-day moving average. That's happened a number of times recently, and all in the last 6 months when that's happened, the market's resolved higher, the stock has resolved higher. At this point, it's sort of fading a bit right at that ascending 50-day moving average. Does it hold the 50-day? Does the RSI remain above 40? That would be sort of a garden variety pullback and could be the next to a nice big leg moving higher. If it breaks that, I think that's when you have to start to be concerned about stocks that a lot of people have been expected to be in a pure bullish mode, starting to falter a little bit, and whether that means there's further downside. Sort of that risk on trade is, at least in this particular example, has tapered off. So a key stock at a key level. We talked about Plug Power yesterday in a very similar condition, so far bouncing off of it just fine. Finally, when I'm looking across the equity landscape, I'm finding plenty of stocks that appear to be going higher. Most recent example from today, American Express, just making a new 52-week high today, up 2.5%. This is breaking out of another base, continuing to make a pattern of higher highs, higher lows. It broke its 50-day, but sort of remained right around that support level from December, and now has broken back to the upside. Not yet overbought, relative strength threatening a new, say, 9 or 10 month relative high. So I'm not at a shortage of stocks continuing to move higher. And again, I assume the trend is up until proven otherwise. Folks, that is our show, and that is a wrap for this week on the Final Bar. Thank you so much for joining us every weekday after the close. Check out our new on-demand platform, just out, stockchartstv.com, and also on all your mobile devices. Check it out. Let us know what you think. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good weekend. See you on Monday.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.